Hello and welcome to another episode on Finance Foundations for Business Owners. In the last episode, we looked at why your bank account can be empty even when sales are good. Today, we are building the tool that prevents that from happening again. A simple 13-week cash flow forecast. Here's the problem most business owners are trying to solve. They know money is coming in, they know money is going out, but they cannot see far enough ahead to know whether there will be enough until they are already in trouble. Most businesses do not run out of money suddenly. The warning signs were usually there: unpaid invoices that needed chasing, VAT or tax money that should have been protected, a month where outgoings were going to exceed income. The problem was not that the owner did not care. It was that they could not see it coming early enough. That is exactly what a 13-week cash flow forecast gives you. Not a crystal ball, not a guarantee. Just enough visibility to act before a problem becomes a crisis. Today, I'm going to show you how to build one in simple, practical terms, and we will walk through a real example together. So what is a 13-week cash flow forecast? A 13-week cash flow forecast is a forward-looking view of your business cash. It shows week by week a projection of the business cash inflows and outflows and what your bank balance will look like at the end of each week, covering exactly one fiscal quarter. It is not the same as your profit and loss account. It is not your tax return. It answers one practical question. Based on what I know today, will my business have enough cash over the next 13 weeks? You may be wondering, why 13 weeks? Because that is roughly one quarter, short enough to be realistic and long enough to spot danger before it hits. A one-week view is too short, while a full year forecast can feel too distant. 13 weeks is your operating window. Think of a cash flow forecast like a car windscreen. Your account tells you where you have been, your bank balance tells you where you are at today, but your cash flow forecast helps you see the road ahead. And when you can see what is coming, you have time to act. A 13-week cash flow forecast needs just 5 lines, 5 rows and 13 columns. And line 1 is your opening bank balance. That is the cash you have at the start of the week. Line 2 is your cash coming in. This includes your customer payments, expected invoice receipt, and confirmed sales receipts. Line 3 is the cash going out. This includes rent, wages, suppliers, loan repayments, VAT, tax, everything that is leaving the account. Line 4, net cash movements. That is cash in minus cash out. Line 5 is your closing bank balance. That is your opening balance plus or minus the next movement. Then the closing balance for week 1 becomes the opening balance for week 2. You repeat that for the next 13 weeks. No magic, no complicated formulas, just cash in, cash out, and what is left. Let me show you that with what that looks like with real numbers. So a business starts week 1 with £2,000 in the bank account. That's the balance in the bank. In week 1, 1,005 comes in from a customer's payment. 2,250 goes out in wages, rent, and bills. Net movement, that is minus 850. Closing balance is then 1,150. That 1,150 becomes the opening balance for week 2. In week 2, a ledger payment arrives, which is £3,000. Outgoings are £2,500. Net movement becomes plus 500. Closing balance improves to 1,650. Week 2 looks good, but watch what happens in week 3. Only 1,000 comes in week 3 as incoming, and outgoing are still 2,250. Wages, suppliers, subscription renewal, and the net movement becomes minus 1,250. Closing balance dropped to £300. I beg your pardon. £300, that is the danger week. Without a forecast, the business owner discovers this when the bank account is already at £300 and the pressure is already there. With the forecast, they can see it 3 weeks ahead, which means they have time to chase a late invoice, delay a discretionary purchase, or ask a supplier for a short extension before it becomes a crisis. This is the real value of a forecast. It does not just show the final position. It shows the timing of pressure, and timing is everything. If your forecast shows a cash gap, do not panic. That means the forecast is doing its job. The real problem is discovering the gap when it is too late to act. When you spot a danger week, you have 3 areas to work on. First, bring income in faster by chasing overdue invoices before the week arrives. Ask for deposit on new work, shorten payment terms for new customers. A payment arriving a week earlier can completely change the picture. And secondly, control what goes out. Delay non-essential spending, pause subscription you are not using, negotiate a supplier's payment date before the invoice is due. Most suppliers would rather agree a short extension than chase a late payment. And third, protect what is already committed. Ring-fence the money that belongs to HMRC, be it VAT, tax, pay, before it gets accidentally spent. This money is not yours. Treating it as available is how businesses build up a tax debt without realizing it. A forecast does not make every decision easy, but it makes the decision visible. That is the difference between financial panic and financial control. Here are 5 mistakes to avoid when you build your first forecast. Number 1, forecasting sales instead of cash. Remember, this is not about when you make the sales. It is about when money enters your bank. The forecast track when money enters your bank account, not when you make the sale. A confirmed order is not cashed until the payment arrives. Number 2 mistake to avoid, being too optimistic. If a customer normally pays late, do not pretend they will suddenly pay early just because the spreadsheet looks better. Use realistic timings based on what actually happens. And the third mistake to avoid is forgetting VAT and tax. Money owed to HMRC is not available spending money. Build in the VAT quota and any tax payment as committed outgoings. Number 4, not updating the forecast weekly. A forecast you fill in once and forget is not a tool. It needs to be updated every week as actuals replace estimates and new information arrives. And the number 5 mistake to avoid is ignoring small recurring costs. A £30 software subscription, £15 card processing fee, £25 monthly insurance payment. Individually, they are small, but across 5 or 10 recurring items, they quietly reduce your closing balance every week without you noticing. Your first forecast does not need to be perfect, but it does need to be honest. An honest forecast is better than a beautiful one that lies to you. Before the day is out, open your Excel, Google Sheets, or even a notebook and do this. Create 5 rows: opening balance, cash coming in, cash going out, next movement and closing balance, and 13 columns, 1 for each of the week. Start with the next 4 weeks if 13 weeks feels too much. Put in your actual balance, add the customer payments you genuinely expect to receive, add every outgoing you know is coming, wages, rent, subscription, suppliers payments, loan repayments, VAT, then find the lowest closing balance out of the 4 months or out of the 13 weeks. Out of the 4 weeks or out of the 13 weeks, whichever you are doing. That lowest week is your cash warning signal. That is where your attention needs to go first. To make this even easier, I have built a simple 13-week cash flow forecast template that you can download and start using today. It has 5 rows pre-built, the 13 column setup, and a formula that automatically calculates your closing balance and highlights your lowest week. The link is in the description below. Download it, open it, and put your own numbers in. That is the starting point. A 13-week cash flow forecast is not just a spreadsheet, it is a business control tool. It helps you see pressure before it becomes panic, it shows whether sales are turning into usable cash, and it helps you make better decisions about spending, stock, tax, owners pay, and growth before this decision become urgent. More importantly, it helps you stop managing your business by guesswork. If this episode helped you, please give it a like. It genuinely helps more business owners find the content. And leave a comment below if you have used a cash flow forecast before and what difference it made. If you need hands-on support with cash flow planning, bookkeeping, or financial management, Tripple P Solutions is there. The link is in the description. Thank you for watching. I'm Bukky from Tripple P Solutions, and I will see you in the next one.